Good morning and welcome to the Killik podcast for Friday the 30th of January. So far this year, the key theme has been the race to the bottom in terms of interest rates and currency devaluation from global central banks. So here we've got a list of 9 different central banks who have eased their monetary conditions. And coming up in the next couple of weeks, we've got South Africa, Mexico, Colombia and Russia due to report to the market and probably see further easing. On the other side of the coin, we've got the FOMC, who gave a statement, their January statement on Wednesday, that was going the other way. So they're telling the markets that actually the economic activity has been expanding at a solid pace. That's a more bullish statement than we've seen from them for a long time. Labour market conditions have improved. Decline in energy has boosted household purchasing power, which we've been looking for. Business investment is advancing. So that's all positive in terms of raising rates and is viewed by the market as sort of a sign that they still want to raise rates. On the other side, what's stopping them raising rates is this deflationary tide that's coming into global markets and also the impact of other issues in international economies such as Greece. So we've got a situation where global rates are coming down and potentially US interest rates are looking to go up. So as a result, you're seeing strong appreciation in the US dollar. We've talked about this many times because they're starting to import deflation to that economy. The Fed have got a 2% inflation target. Over the last quarter of last year, core inflation fell by 0.4. So they're actually moving away from that inflation target. So that makes it very difficult for them to raise rates. So that's becoming a key argument or a key issue in markets, whether they are going to raise rates this year. The Fed are targeting June of this year, but some commentators are now pushing that back into 2016. And that's going to have a key impact on asset prices. So the bond market this week has seen in the US a bit of a rise in the short end of the curve. So that's basically saying that rates are more likely to go up in terms of the official Fed policy rate at the short end. But we're still seeing this huge deflationary effect in markets. So the 30-year bond, which is long-term growth, has gone down markedly. So now you've got a situation actually where over the last 3 months we've seen the biggest fall in 10-year bond yields that we've seen in 35 years. So that's an extreme move over the last month. So in the US, we got some more data. It was fairly mixed. We had a durable goods order data that was poor, but we had some very strong consumer confidence data and new homes data that came out. So that's supporting our view of the domestic economy in the US. Greece continued to be a destabilizing effect. So we had the election on Sunday, and as a result, we saw some fairly big falls in the bank stocks in Greece over the first part of this week. And we saw quite a big rise in the 10-year gilt, so the cost of borrowing for Greece. But so far, we're not seeing that spread into other markets. So these are the peripheral yields, so Italy, Spain, Portugal. We're not seeing the cost of their borrowing going up. So the market continues to feel that these issues are contained. Just going back to that global easing, as we can see here, we're now starting to see the money supply starting to expand in Europe. So here we can see M3, which is the most commonly used metric for money supply. That tends to be a good guide for where inflation is going. But that relationship has decoupled back in the sort of tail end of 2014 as we sort of started to anticipate this big global easing campaign that we're seeing throughout global economies. So the question is how long that is going to continue to decouple and whether we do get a bounce back at some stage. Where we are now in terms of bond yields to dividend yields, because dividend yields have been sustained, is that the bond yield to dividend ratio is around a 100-year high. So we're at very extreme territory in terms of the premium that you get paid for holding equities against the bonds. So the earnings, the S&P Q4 earnings we're now halfway through that particular season, and so far we've seen more positive surprises than negative surprises. As we were expecting, we've seen more positive surprises in financials and technology. That's been good news for our portfolios. But surprisingly, you've actually seen some positive surprise in gas and industrials. So analysts have probably got a little bit too negative, or the impact of lower oil hasn't really come through yet in those numbers. In terms of positive surprises, we had Amazon report last night after hours, a big jump in their share price. So we saw year-on-year sales growth around 15%. We also saw through their guidance that they expect that to accelerate. Amazon Web Services was a very strong growth rate, up 41% on last year, with 90% increase in users. So we continue to really like this story. We feel e-commerce is at a tipping point in terms of usage, with around 80% of the developed world now using online commerce. So we think that accelerates from here. The week ahead, got quite a heavy week in terms of company reporting. BG, BP, Ocado, Walt Disney all on Tuesday. Wednesday, Glaxo, which I'll talk about, Merck, Whirlpool, Yum Brands. Thursday, Smith & Nephew, Vodafone, Cummings and Sanofi. So pretty busy. On Glaxo, we go into these results slightly nervous. Market has got concerns over what the generic competition to their asthma drug Advair is doing. So we're expecting volumes in Advair, which is a key component of their revenues, to be down 10%, with pricing down 15%. They're doing a very big deal in terms of an asset swap with Novartis, which increases their over-the-counter and vaccines businesses, which are more visible, higher quality earnings. So we'll get some more details on that. And we'll also get more details on what's going on in China, whether we're getting a recovery from that bribery scandal. So as you can see here, the market has started to recover and price in a more stable outlook for their dividends. Got quite concerned about the sustainability of the dividend in the back end of last year. So they're looking to pay 80p of earnings. That's around 6% at the low end of the range, and about 5.5 at £15. So we'll be keen to see that maintained, and we expect it will be. Thanks for listening. Have a good weekend.